Billionaires are known to purchase gold, Bitcoin, real estate, and stocks, a fact amplified by relentless mainstream coverage. When gold soars past $4,000 an ounce or Bitcoin nears $100,000, headlines proclaim hedge funds growing interests or highlight the ultra-wealthy diversifying into cryptocurrencies. Similarly, surging real estate markets are attributed to billionaires snapping up prime properties. This narrative dominates public discourse. Assets everyone talks about, analyzes, and claims to understand. But beneath this surface lies a hidden story. While the media fixates on gold and Bitcoin, assets that retail investors chase after for fleeting gains, those with immense wealth have already shifted their focus. They are quietly accumulating three assets most people have never heard of, assets so obscure that many financial advisors can't explain them. These assets are so vital that, in a systemic collapse, they could eclipse gold in value. And they acquire them without fanfare. No press releases, no televised interviews, no tweets. Only through silent, systematic accumulation via shell corporations, private transactions, and intricate legal arrangements designed to hide their ownership. Let me reveal the details. These are the three assets billionaires are acquiring today, in 2025. And most importantly, I will show how you can gain exposure to these assets, all without needing $1 billion. This isn't about mimicking the wealthy. It's about understanding where true value resides when currencies falter, supply chains fracture, and the financial system, such as it is, begins to unravel. Starting with the first asset, farmland. At first glance, it sounds mundane, even boring. But that's precisely why it's so valuable. The billionaires are buying specific types of farmland in select regions with qualities most people overlook. Among them, Bill Gates stands out as the largest private farmland owner in the U.S. By 2025, Gates controls roughly 275,000 acres across the country. That's more than 430 miles of farmland, larger than Los Angeles, and comparable in size to Hong Kong. Through his investment vehicle, Cascade Investment, Gates has been methodically accumulating land since 2013, more private farmland than anyone else. But his acquisitions aren't random. They follow a distinct pattern. Gates favors specific types of land, in particular locations, for reasons that transcend simple agriculture. His largest holdings are in Louisiana, specifically in the Mississippi River Delta, a region that holds unique strategic advantages. This land isn't just random plots. It is characterized by three critical features that make it irreplaceable. First, the soil quality is extraordinary. Some of the richest topsoil in North America, deposited over millennia by river flooding. Second, water access is guaranteed. These lands sit atop vast aquifers, with abundant river water for irrigation. Third, the region enjoys an extended growing season, with some fields producing 2 full crops annually. Such land isn't purchased for today's food production alone. Gates is acquiring the ability to control food supply capacity when environmental and economic conditions threaten global agriculture. His investments in regions like Louisiana symbolize strategic positioning, safeguarding resources for uncertain futures. This pattern extends beyond Louisiana. In Arkansas, Gates owns nearly 50,000 acres, land pivotal for rice and soybean cultivation, with reliable water sources from the Arkansas River. Further north, in Nebraska, he owns farmland situated above the massive Ogallala Aquifer, North America's most significant underground water reserve, ensuring future irrigation for a century or more. In Washington state, he has interests in the Columbia River Basin, a prime region for wheat, potatoes, and fruit, with perpetual water access from the Columbia River and excellent infrastructure for export. His holdings in Florida, focusing on citrus, vegetables, and cattle, follow the same principle: productive land with dependable water access and favorable climate. Each purchase underscores a core strategy: acquiring land not to farm immediately, but to leverage it as a critical resource when breakdowns threaten global supply chains. Most recently, Gates expanded his farmland portfolio in 2025 by acquiring 8,800 acres in Benton County, Washington, paying approximately $16,000 per acre, more than quadruple the national average. This land, in the Horse Heaven Hills region, already features irrigation systems, aquifer access, and valuable mineral rights. Assets designed for future control, not immediate profit. This leads us to the second asset, water rights. Unlike the land itself, water rights aren't physical commodities but legal entitlements to extract and utilize water. In the Western United States, water rights are allocated under a system called prior appropriation, first in time, first in right. Those who claimed rights earliest, often in the 1800s, possess priority, especially during shortages. Billionaires have recognized this value long ago. They quietly acquire rights separate from land ownership, betting on future scarcity. Take T. Boone Pickens, a Texas billionaire famous for oil, who in the 1990s purchased extensive water rights over the Ogallala Aquifer, enough to supply a city of 1 million people annually. In 2011, he sold part of those rights to Texas municipalities for over $100 million, not for the water itself, but for the legal rights to pump it. Today, water rights are a thriving industry. Firms like Water Asset Management buy farmland in Colorado, where the land itself might be worth $50 million, yet the accompanying senior water rights can be valued at over $300 million. Their strategy: improve the efficiency of farms to use less water, then sell or lease the excess rights to burgeoning urban centers and developers desperate for supply. In California, the Resnick family, owners of the popular food brands, invested heavily in farmland with water rights, gaining control of major water storage facilities like the Kern Water Bank. They profit from droughts by controlling access to stored water, selling it at premium prices. Similarly, the Mormon Church bought thousands of acres in Washington state, acquiring the right to guaranteed water from the Columbia River system, an insurance policy for future needs. Some companies, like Crown Columbia Water Resources, attempted to buy vast quantities of water rights across the Columbia Basin to resell or lease, plans curtailed by public resistance but ongoing through smaller, quieter transactions. All these moves reflect a broader trend. In a region facing climate change-induced drought, snowpack decline, and aquifer depletion, the control of water rights is becoming one of the most valuable assets. The third obscure asset gaining rapid traction among the ultra-rich is catastrophe bonds, sometimes called cat bonds. These financial instruments transfer disaster risks, such as hurricanes or earthquakes, from insurers to investors. Here's how they work. An insurance firm creates a shell company that issues bonds to investors, backed by collateral, usually government securities. Investors receive high interest, perhaps 9 to 14%, while their principal is at risk if a designated disaster occurs. In the event a catastrophe like a hurricane or earthquake exceeds a preset threshold, say, damages surpassing $10 billion, the bond triggers, and investors lose their principal. But most of the time, no disaster occurs. Investors collect steady high yields over many years. This uncorrelated, disaster-resistant asset class has thrilled those seeking diversification. Despite the inherent risk, the returns are compelling. In 2024, catastrophe bonds offered average yields of nearly 17.5%, more than double what stocks returned that year. Even during market turmoil, such as in 2025 when equities plunged due to economic tensions, these bonds maintained their high yields, unperturbed by economic cycles because their triggers are natural hazards, not market conditions. This market is exploding because climate change is increasing the frequency and severity of disasters. Insurers are turning to capital markets to manage the rising volume of claims. Meanwhile, the asset class is becoming mainstream. In 2025, over $50 billion in outstanding catastrophe bonds compares to $33 billion 5 years earlier, with annual issuance reaching record highs. Major pension funds, hedge funds, and insurance firms acquire and manage these securities, recognizing their value as uncorrelated, inflation-protected, disaster-resistant assets. They offer consistent high returns, outpacing traditional investments, with the added advantage of resilience during crises. What unites these three assets, farmland with water access, water rights, and catastrophe bonds, is their scarcity, essential nature, inflation resistance, and disaster resilience. They aren't easily created or replaced. They're deeply rooted in geography, geology, and the natural environment. They are vital human needs: food, water, and protection against catastrophe. In times of currency devaluation or systemic collapse, these assets not only hold their value, they become more precious. Farmland's value climbs as food prices surge, water rights gain prominence amid scarcity, catastrophe bonds pay floating, inflation-linked yields regardless of economic turmoil. How can you access these assets without billions? For farmland, real estate investment trusts, such as Farmland Partners and Gladstone Land, own thousands of acres and pay dividends, making exposure affordable. For water rights, indirect methods include investing in water infrastructure companies or ETFs related to water utilities and technology. For catastrophe bonds, mutual funds and ETFs like the Pioneer Cat Bond Fund or Swiss Re's Index track the entire asset class, offering diversification with manageable minimum investments. This isn't financial advice, but a perspective. The wealthiest are allocating capital to these assets because they understand the system is unsustainable. They're preparing for a future when food, water, and disaster risk management become the core foundations of value, long before the masses catch on. Bill Gates didn't amass so much farmland by chance. Boone Pickens bought his rights when their true value was unrecognized. Pension funds shifted into catastrophe bonds because traditional assets failed in 2022. The pattern is clear. In a world where currencies falter, supply chains break, and crises become common, these assets will preserve wealth beyond stocks or bonds. The question is, do you see it in time? That's the key, recognizing the trend before everyone else does. Because when everything else fails, the control of essentials, food, water, and disaster risk transfer will determine who emerges wealthiest. That region possesses three vital qualities that render it irreplaceable. First, the soil fertility. The Mississippi Delta boasts some of North America's richest topsoil, deposited over thousands of years by river flooding, a natural formation that cannot be replicated artificially. Second, water abundance. Sitting atop immense aquifers and benefiting from unrestricted river access, this land guarantees irrigation even as water scarcity threatens other areas. Third, the length of the growing season. Louisiana offers one of the longest in the United States, enabling some land to yield 2 full crop cycles annually. This isn't solely about cultivating food today, but about asserting control over future food production capacities, especially as climate change reduces arable land elsewhere. Gates's second-largest landholding spans nearly 47,927 acres in Arkansas, a region renowned for rice and soybean crops, with direct access to the Arkansas River and the largest rice-producing area in North America. Here, water-intensive crops thrive in a region with a guaranteed water supply. Spotting the pattern yet? The third major concentration is in Nebraska, above the Ogallala Aquifer, the largest underground water reservoir in North America, supplying 8 states, but now rapidly depleting in many regions. Gates purchased land where the aquifer is deepest and recharge rates are highest, ensuring water access for the next century. In Washington state, nearly 1,697 acres in the Columbia River Basin offers an ideal climate for wheat, potatoes, and fruit, with abundant water from the Columbia River system and infrastructure for exporting crops to Asia via West Coast ports. In Florida, nearly 15,000 acres are dedicated to citrus, vegetables, and cattle, with a perennial growing season and aquifer access. Every one of these acquisitions follows the same core pattern: highly productive farmland with unmatched soil quality, long-term guaranteed water access, whether from rivers or deep aquifers, and climate conditions conducive to multiple or high-value crops. Gates isn't buying land to farm actively now, but to secure the capacity to influence global food supplies when the worldwide food system falters. And the acquisitions are ongoing. As recent as June 2025, his investment firm purchased over 8,000 acres in Benton County, Washington, at a cost of more than $131 million, about $16,000 per acre. To put that into perspective, the average American farmland sells for roughly $3,000 to $4,000 per acre. Gates paid quadruple the average because this land in the Horse Heaven Hills region already features pivot irrigation installed, direct aquifer access, ideal climate, and, most importantly, mineral and water rights embedded in the deal. This brings us to the second asset, water rights. The the legal authority to extract and utilize water, not the water itself. This asset may well be the most valuable of the 21st century. Let me clarify how water rights operate, as many people lack understanding of this system. In the western United States, ownership of land is separate from the rights to use the water beneath or flowing through it. You could own 1,000 acres of land, but have no legal claim to extract or utilize the water on or beneath that property. Most water rights in these states are assigned through a system known as prior appropriation, summed up as first in time, first in right. Essentially, those who claimed water rights earliest, often 1800s ranchers and farmers, hold senior rights. In drought conditions, senior rights take precedence, securing their full allocation first, while junior rights holders receive whatever remains, which can sometimes be nothing. Now, here's where the value becomes apparent. Water rights can be bought, sold, and transferred independently of land ownership. If you possess senior water rights in an area where water resources are dwindling, you are sitting on immense value. Every city, developer, and farmer needs water, and when supplies become limited, those who control the rights determine the market price. Recognizing this, billionaires have been quietly amassing water rights for the past 2 decades. A prime example is T. Boone Pickens, the Texas oil magnate who diversified into water. During the 1990s, Pickens began acquiring land in the Texas Panhandle, not for farming or ranching, but for the water stored beneath it. The land overlays the Ogallala Aquifer, one of the largest underground water sources. Through this, he accumulated rights to extract approximately 65 billion gallons annually, enough to supply a city of 1 million residents. In 2011, he sold some of these water rights to 11 Texas cities, including Amarillo and Lubbock, earning over $103 million, paid solely for the legal rights to pump water, not the land or the water itself. This sale yielded a tenfold return compared to traditional water prices, exemplifying the immense profit in controlling water access. Pickens retains the majority of his rights, which are valued today at over $500 million. He's not alone. An entire industry of Wall Street firms has emerged, acquiring water rights across the American West. Water Asset Management, based in New York, has methodically purchased farmland in Colorado primarily for its water rights. The firm acquired over 2,500 acres along the Colorado River, the land worth perhaps $50 million, but the attached senior water rights valued at over $300 million. In a 2022 interview, the firm's president stated their goal is to profit from water scarcity by acquiring land with senior rights, improving efficiency to reduce water use, and then selling excess rights to eager cities and developers. This practice, water arbitrage, is perfectly legal. In California, the Resnick family has advanced this strategy even further. Owners of the renowned company behind pistachios, pomegranate juice, and mandarins, Stuart and Linda Resnick, have built their wealth not from the crops themselves, but from controlling water access through buying land and water rights. During the mid-90s, they began acquiring large swaths of farmland in California's Central Valley, along with water rights attached. Subsequently, following regulatory changes in 1994 that facilitated private control of water storage, known as water banking, they gained control over the Kern Water Bank, California's largest water storage facility. During droughts, they sell stored water at significant markups, generating billions in revenue purely from access to water that was publicly stored. This approach is not limited to them. The Church of Jesus Christ of Latter-day Saints, in 2021, invested over $200 million in farmland in Washington state, outbidding Bill Gates's firm in an auction, primarily for its senior water rights along the Columbia River. They now rank among the largest private landholders in the western United States, with wealth derived from guaranteed water access rather than crop production. Other entities, such as a Wall Street-backed company called Crown Columbia Water Resources, sought to acquire extensive water rights across the Columbia Basin, an effort halted by public protests, but still ongoing through smaller, less conspicuous transactions. The overarching pattern is clear. Water rights in the West are becoming concentrated in the hands of billionaires and financial firms who understand that water scarcity is inevitable. Climate change is diminishing snowpack in the Rockies, with the Colorado River's flow reduced by about 20% over the past century. The Ogallala Aquifer is being pumped faster than it can recharge, and projections indicate that both supply and recharge rates will continue to decline. Control over water in this context will soon be more valuable than oil, an asset that sustains life and economic activity, making its ownership a key source of wealth preservation for the future. Water rights have become a prized asset, particularly in California's Central Valley since the 1990s, when residents began acquiring vast stretches of farmland, tens of thousands of acres, along with the rights to the water beneath them. However, their ambitions went beyond land purchases. In the mid-1990s, California convened a series of water management meetings, attended notably by the Resnicks, that few cities paid much attention to. These gatherings led to new regulations permitting private entities to oversee water banking. Water banks, structures built with taxpayer funding, store surplus water during wet periods and release it during droughts. The regulations allowed private companies to control these stored reserves and enforce pricing. The Resnicks gained control of California's largest water bank, with a capacity of about 1.5 million acre-feet, roughly 500 billion gallons. During increasingly frequent droughts, they've sold water to farmers and cities at significant markups, generating billions, not through farming or water production, but through controlling access to public infrastructure's stored resource. The trend isn't isolated. In 2021, the Church of Jesus Christ of Latter-day Saints purchased 20 to 2,500 acres of farmland in Washington state for over $200 million, outbidding Bill Gates' investment firm in an auction. Why such a hefty investment? Water rights. That land comes with senior water rights on the Columbia River system, securing guaranteed water access indefinitely. The church has become one of the largest landholders in the western United States, not for crops, but for exclusive water rights. The same year, a Wall Street-backed firm, Crown Columbia Water Resources, filed plans to acquire private water rights across the Columbia River watershed. They intended to purchase water rights from farmers, bank them with the state, and lease or sell that water to urban areas and developers, aiming to make the largest private water rights deal in U.S. history. Public opposition forced them to suspend the plan, but the firm persists, quietly engaging in smaller transactions beyond regulatory scrutiny. This pattern clearly indicates that water rights in the American West are rapidly consolidating into the hands of billionaires and investment firms who recognize the inevitability of water scarcity. Climate change has been steadily reducing snowpack in the Rockies, causing the Colorado River's flow to decline by 20% over the past century, while the Ogallala Aquifer is being drained faster than nature can replenish it. Expert projections warn that by 2030, the ownership of water rights will surpass the value of oil assets, because unlike oil, water is essential to life, an irreplaceable resource whose control will determine wealth and power in the decades ahead. The third asset, largely obscure and seldom understood, has seen the ultra-wealthy flocking to it with record-breaking enthusiasm in 2025. Most ordinary investors have never encountered it, and few financial advisors could explain its intricacies. This asset is known as catastrophe bonds, or cat bonds for short. Let me clarify what they are and why they're experiencing such explosive growth. A catastrophe bond is a financial instrument issued by insurance and reinsurance companies to shift disaster risks onto investors. Here's how it functions. Suppose an insurer covers properties in Florida against hurricanes. Should a devastating hurricane strike, the insurer could face billions in claims, more than they can easily absorb. Traditionally, they turn to reinsurance, paying another firm to shoulder part of the risk. However, reinsurance is costly and capacity-constrained, prompting insurers to issue cat bonds instead. In this process, the insurer sets up a special purpose entity, essentially a shell company, that issues bonds to investors, sometimes totaling hundreds of millions of dollars. The money raised is placed into a collateral account, usually invested in safe treasury bonds. The insurer then pays investors a premium, often ranging from 5 to 10% above treasury yields. For example, if treasury bonds yield 4%, then these cat bonds might pay 9 to 14% annually if no disaster strikes that year. Investors receive their principal back along with the premium, enjoying a relatively high return with low risk, until disaster strikes. However, if a natural catastrophe, such as a hurricane, causes damages exceeding a preset threshold, say $10 billion, the bond is triggered. The collateral, initially invested in Treasury securities, is transferred to the insurer to cover claims, meaning investors lose their principal and the bond defaults. In essence, these are high-yield bets on the occurrence of rare, severe disasters. If the disaster happens, investors lose everything. If not, they enjoy handsome profits. It may seem reckless, even insensible, to invest in bonds that could be wiped out by a hurricane, but the logic is compelling. Billionaires, hedge funds, pension funds, and sovereign wealth funds recognize the high, uncorrelated returns because natural disasters don't follow economic cycles. The numbers are striking. In 2024, catastrophe bonds averaged a return of 17.4%, outperforming the S&P 5-to-1. The previous year, returns climbed even higher, nearing 20%, outpacing both stocks and bonds by a wide margin. What's more, during the market collapse caused by tariffs and economic turmoil in 2025, catastrophe bonds held steady and continued paying high yields, even as stocks and real estate plummeted and gold dipped briefly. This is because these bonds are linked not to economic activity but to physical events, earthquakes, hurricanes, floods, that occur independently of financial markets. The significance is profound. Catastrophe bonds are emerging as a critical diversification tool. Their ability to deliver strong returns uncorrelated with traditional assets makes them highly attractive to sophisticated investors. As the market expands rapidly, its value soaring from $33 billion in 2020 to over $50 billion in 2025. Wealthy players are positioning themselves well before the wider market recognizes their potential. Billionaires understand a lesson that many retail investors overlook. True diversification goes far beyond stocks and bonds. Since both are tied to economic conditions, a downturn impacts them simultaneously. Genuine diversification involves owning assets whose success isn't closely linked to the economy's fluctuations. Catastrophe bonds, commonly known as cat bonds, are the quintessential example of this principle. The market for these specialized securities has experienced rapid growth. By November of 2025, the global outstanding value surpassed $50 billion, a significant jump from just over $33 billion in 2020, marking a 50% increase in only 5 years. The flow of new issuance is also accelerating. In the 12 months spanning August of 2024 to July of 2025, insurers issued a record-breaking $23 billion worth of new cat bonds. This surge can be attributed to 3 key factors. First, climate change has led to increased frequency and intensity of disasters, causing insurers to face mounting claims that traditional reinsurance cannot fully cover. As a result, they are increasingly turning to capital markets for solutions. Second, rising insurance premiums mean higher coupon payments on cat bonds, making them more attractive to investors seeking elevated yields. Third, savvy investors have recognized these bonds as genuine diversification tools, especially evident in 2022, a year when both equities and bonds plummeted simultaneously, obliterating typical portfolios. Yet, cat bonds delivered a 5% return, illustrating their unique resilience. This evolution has attracted a broad spectrum of investors. Hedge funds dedicated exclusively to insurance-linked securities, like firms such as Capital Management, Employment Investments, and Stone Ridge Asset Management. These sophisticated vehicles manage billions of dollars, with pension funds, such as California's Public Employees Retirement System, and institutional investors from Canada, Europe, and the Middle East, adding to the demand. Even reinsurers like Swiss Re and Munich Re participate actively, issuing and purchasing cat bonds, recognizing their importance within a diversified risk management strategy. The hunger for high-yield, uncorrelated assets is driving this market's expansion. From 2025 back to its earliest days in the late 90s, cat bonds have consistently outperformed expectations, generating annual yields approximately 4 percentage points above the expected risk cost. This premium arises because investors demand compensation for venturing into an unfamiliar territory, a relatively inefficient market where skilled modeling of disaster risk can reveal mispricings and lucrative opportunities. Take, For example, the 2011 issuance of a bond named Mariah Ray by American Family Mutual Insurance. It covered severe thunderstorms and tornadoes across the United States, a predictable risk based on historical data. Yet, when the deadliest tornado season in American history unfolded that year, with over 983 tornadoes and damages exceeding $21 billion, the bond triggered, resulting in investors losing their principal. Despite such losses, a diversified portfolio of cat bonds over the decades still yielded an average of 11% annually, with most bonds not triggering at all. These high and steady yields benefit from the fact that catastrophe bonds are fundamentally uncorrelated with traditional assets, such as stocks and bonds. As climate change intensifies, their importance as a core diversification tool grows, covering risks like hurricanes, earthquakes, wildfires, floods, and even pandemics. Increasing issuance comes from not only specialized reinsurance firms, but also primary insurers like Allstate and State Farm, who are now bypassing traditional reinsurers and directly accessing capital markets. This shift signals that cat bonds are becoming mainstream infrastructure for risk transfer within the insurance ecosystem. Their rising prominence is akin to where the mortgage-backed securities market was at the turn of the millennium: early, high yield, not yet fully understood, and rapidly expanding. Smart investors recognize this pattern, positioning beforehand for a future where traditional financial assets might falter, but these indestructible, essential assets continue to provide stability. Getting direct access to such assets isn't feasible for most, but alternative avenues exist, investing in funds specializing in insurance-linked securities, like mutual funds and ETFs. For example, funds such as the Pioneer Cat Bond Fund or Swiss-based indices offer exposure, allowing individual investors to participate with manageable amounts, sometimes as low as $1,000, while benefiting from professional management and diversification across many cat bonds. In essence, these assets, farmland with water rights themselves, and catastrophe bonds, share key qualities. They are scarce, vital for survival, inflation-proof, and resilient under disaster scenarios. They can't be created at whim. They are fixed by geography, history, and nature. Their value rises as scarcity intensifies, and they perform independently of economic booms and busts. Billionaires are amassing these assets not for quick profits, but as critical hedges for a future of upheaval and instability. Recognizing this pattern, how they systematically move capital into these essential resources can inform individual investors about safeguarding wealth beyond conventional stock and bond markets. Remember, this isn't financial advice, but rather insight into a paradigm shift. The rich are positioning now, in 2025, for a world where traditional systems may fail. And when they do, control over food, water, and disaster risk transfer will be the most valuable wealth of all. The question is whether you see these signals in time to act accordingly. In 2025, the market for catastrophe bonds, often called cat bonds, is experiencing a significant transformation. These financial tools, which transfer disaster risks like hurricanes, earthquakes, and wildfires from insurers to investors, have historically paid around 6.25% annually for taking on such risks. Their structure was straightforward. If a disaster like a tornado caused industry losses exceeding roughly $825 million in a year, the bond would trigger, and investors would forfeit their initial $100 million principal. Analyzing past data, tornado-induced losses surpassed this threshold roughly once every 10 to 15 years. Investors, therefore, earned a decent risk premium, about 6.25%, compared to the typical odds of occurrence, making the odds seem favorable. But the severity of 2011 disrupted that assumption. That year, the United States endured its deadliest tornado season on record, with nearly 1,000 tornadoes and $21 billion in damages. Industry losses soared to over $954 million, causing the bond to trigger and investors to lose their entire $100 million in principal. However, even with that significant loss, a diversified portfolio of catastrophe bonds held from 2010 through 2020 still provided an average annual return of approximately 11%. The reason? Most bonds did not trigger, and the few that did were more than offset by the high yields from the bonds that remained untouched. Investing in this arena is essentially a game of probability. Diversifying across many such bonds allows investors to withstand occasional triggers while collecting high yields overall. This uncorrelated performance, independent of stocks, bonds, or real estate, is why pension funds and billionaires continue to pour capital into it. What makes 2025 especially notable is the structural shift underway in the cat bond industry. Previously, around 75% of these bonds were linked primarily to hurricane risks concentrated along Florida, Texas, and the Gulf Coast. But from 2022 to 2025, issuance has begun expanding into risk areas such as earthquakes in California and Japan, wildfires in California and Australia, European floods, and even pandemic mortality risks. Furthermore, the sources of issuance have diversified. In earlier years, almost all cat bonds were issued by reinsurance firms. Now, primary insurance companies, like Allstate, State Farm, and Farmers Insurance, are increasingly issuing directly in the capital markets, bypassing traditional reinsurance arrangements. In 2025, over 58% of issued cat bonds came directly from insurers, up from less than half just a few years prior. This evolution signals a fundamental shift. Catastrophe bonds are becoming a core infrastructure component of the insurance industry rather than a niche product. Their increasing liquidity, diversification, and depth reduce their risk for savvy investors. In essence, the 2025 market for cat bonds resembles where the mortgage-backed securities sector stood in 2000. It was an early-stage, high-yield, niche asset class that was largely misunderstood, yet rapidly expanding and eventually becoming central to mainstream investing. Smart money, like billionaires, are positioning themselves now, well before the general public catches on and yields compress. The reason these assets are gaining attention lies in their shared characteristics: scarcity, essentiality, inflation resistance, and disaster resilience. Farmland with water access, water rights, and catastrophe bonds. They all embody these qualities, making them particularly valuable in a world increasingly threatened by climate change, resource scarcity, and systemic instability. Let's simplify this. Farmland with access to water and rich soil can't be easily reproduced. It's a product of geological history spanning thousands of years. Only a limited number of acres lie above vast underground aquifers, and water rights, allocated back in the 1800s, are finite. Disasters, too, are region-specific, fixed by geography and climate, making risk predictable. Food, water, and disaster insurance are essential human needs that cannot be optional in this system. When currencies devalue, farmland prices tend to rise alongside food costs. Scarcity increases the value of water rights, especially as access becomes limited. Catastrophe bonds, tied to inflation, increase yields when inflation rises, preserving their worth. These three assets, farmland, water rights, and catastrophe bonds, are inherently resilient. Farmland has withstood economic crises like the Great Depression and the 2008 collapse, and will likely withstand the next. Water rights remain vital, gaining value as supply diminishes. Cat bonds are crafted to endure disasters, offering high yields because their performance isn't linked to stock markets or bonds. When equities plummet and currencies falter, these assets continue to generate value. Billionaires aren't accumulating these assets for quick profits. They're safeguarding wealth over the coming decades against a world of unstable currencies, scarce resources, and volatile markets. These aren't speculative plays. They're fundamental shields for civilization's infrastructure. Now, how can you access these assets without billions? You can't buy hundreds of thousands of acres in Louisiana or outbid Bill Gates for farmland in Washington, nor negotiate water rights in Texas or invest millions directly in catastrophe bonds. But you can gain exposure through more accessible avenues. For farmland, real estate investment trusts, REITs, that own farms are an excellent entry point. For example, Farmland Partners owns over 177,000 acres across 300 farms, paying quarterly dividends with shares costing around $11 each as of late 2025. Similarly, Gladstone Land Corporation owns 112,000 acres focused on high-value crops, offering monthly dividends at about $15 per share. While these aren't perfect substitutes for direct ownership, they lack tax benefits and control over water rights. They provide exposure to farmland appreciation and agricultural income with minimal capital. Fractional farmland investment platforms like AcreTrader and Farm Together pool investors' funds to acquire specific farms. These allow individuals to invest as little as $15,000, owning a fractional share and earning proportional income, bringing you closer to direct ownership than typical ETFs. Certain investments provide indirect exposure to water scarcity, such as water utilities like American Water Works, ticker symbol AUK, which owns rights and infrastructure across various states. As water shortages become more severe, these companies stand to benefit. Water technology firms like Xylem, ticker XYL, which manufacture pumps, filtration, and management systems, see increased demand amid rising scarcity. Water-focused exchange-traded funds, such as the UNESCO Water Resources ETF, ticker PHO, bundle water infrastructure and utility companies, offering a diversified way to tap into this trend, though not direct ownership of water rights like those on the Colorado River. While these options aren't perfect substitutes for owning senior water rights, they enable exposure to water scarcity's economic value without complex legal negotiations. For catastrophe bonds, there are now mutual funds and ETFs accessible to individual investors, like the Stone Ridge High Yield Reinsurance Risk Premium Fund, ticker SHRX, which invests in insurance-linked securities, or the Pioneer Cat Bond Fund, ticker CBYX, a mutual fund offering diversified exposure with daily liquidity. These funds typically require minimum investments of around $1,000, but carry management fees of 1 to 2% annually, which reduce overall returns. Nevertheless, they provide a way to access this asset class, traditionally favored by pension and hedge funds, without directly purchasing individual bonds. There are also broader market instruments, such as the Swiss Re Catastrophe Bond Index ETFs, which track the overall catastrophe bond market with returns generally aligned with the market average, offering lower risk than individual bonds. It's crucial to understand that this isn't financial advice, nor a recommendation to buy specific assets. Instead, it's a glimpse into what the ultra-wealthy are increasingly accumulating and why. Namely, resources that are scarce, essential, inflation-resistant, and disaster-proof. These assets are not investments aimed at quick profits, but are strategic holdings for the future. Their appeal lies in the understanding that, as our current financial system proves unsustainable, control over food, water, and disaster risk transfer will determine long-term wealth preservation. Assets that, unlike stocks or bonds, are likely to withstand systemic breakdowns. If this resonates, remember, this is about recognizing patterns, understanding value, and acting accordingly before broader markets catch on. If you enjoyed this video, please subscribe for more content like this. These assets, farmland with water rights themselves, and catastrophe bonds, are what sustain wealth through profound regime shifts. In 2025, they are being amassed quietly, long before most recognize the impending upheaval. Bill Gates became America's leading private farmland owner not by coincidence. Over 12 years, he accumulated it with deliberate strategy. Similarly, Boone Pickens did not stumble upon water rights worth $500 million. He acquired them when few understood their true value. Pension funds did not suddenly pour billions into catastrophe bonds out of boredom. They recognized that traditional diversification had failed in 2022 and sought uncorrelated assets for resilience. The pattern is unmistakable, the trend evident. The crucial question is whether you see it in time to position yourself accordingly. These are not the only assets gathering momentum. Rare earth elements, nuclear infrastructure, agricultural tech, and strategic commodities also feature. But today, farmland with water rights, pure water rights, and catastrophe bonds are at their peak of accumulation and remain accessible to those outside the billionaire class. If nothing else, remember this. When billionaires systematically amass assets that seem dull or insignificant now, it's a signal. They're not investing for immediate gains. They're preparing for the collapse of the current system. On that day, control over food, water, and disaster risk transfer will bestow far greater wealth than holding stocks or bonds in a failing currency. This isn't a message of doom, but one of pattern recognition. Throughout history, every reserve currency has followed this path. The wealthy who perceive the signs early move their assets into tangible, fundamental resources years before the final transition. This moment is here. Whether you act on it is entirely your choice.